10 days. That's all that remains before one of the most consequential shifts in the global commodities market quietly takes effect. On January 1st, 2026, China will flip a switch. No announcement fanfare, no emergency summit, no dramatic headline, at least not yet. But once that switch is flipped, the global silver market as we know it may never function the same way again. Because starting January 1st, every ounce of silver leaving China will require direct government approval. And China doesn't just produce silver, China controls the flow. Part 1. Why January 1st? Matters China accounts for 60 to 70% of the world's tradable silver. That does not mean China mines that much silver. It means China refines it, processes it, trades it, exports it. Silver mined in Latin America, Africa, and Central Asia often passes through Chinese refineries before entering global markets. China is not just a supplier. China is the gatekeeper. Beginning January 1st, 2026, that gate closes. Not entirely, but selectively. Under the new rules, silver exports will require individual government licenses. Large, state-aligned entities may still receive approval. Small traders, arbitrage desks, and independent exporters will not. This effectively removes flexibility from the global supply chain. Silver will no longer flow to where prices signal it should go. It will flow to where Beijing decides it should go. That distinction changes everything. Part 2. The market is already broken. If this were happening in a balanced market, the effects might be manageable. But this is not a balanced market. In October 2025, China executed what many analysts described as an emergency export. Roughly 660 tons of silver, more than 21 million ounces, were released into global markets. The intention was clear. London vaults were under pressure. Delivery demands were mounting. Paper prices were becoming unstable. This export was supposed to calm the market. Instead, silver surged. Prices did not fall. They did not stabilize. They accelerated, pushing to a new all-time high of $69.36 per ounce. That single data point tells us something critical. Industrial demand is now so strong that even massive coordinated supply injections fail to relieve price pressure. This is not speculation. This is consumption. Part 3. China's real motive. Officially, China frames the export licensing regime as resource protection. And on the surface, that makes sense. China consumes roughly 19,000 tons of silver per year. China produces only about 3,300 tons domestically. That gap must be filled through imports. But this policy is not just defensive. It is strategic. Solar dominance China manufactures around 80% of the world's solar panels. Silver is a critical input in photovoltaic cells. Without silver, solar output drops, efficiency collapses, production lines stop. By restricting exports, China ensures domestic manufacturers retain guaranteed supply. Input costs remain controlled. Foreign competitors face soaring prices and shortages. This is not new. It is the rare earths playbook, rewritten for silver. In 2010, China restricted rare earth exports. Prices exploded. Western industries scrambled. China consolidated dominance. Silver is next. Part 4. The structural deficit. No one can fix. This crisis did not start in 2026. It has been building for years. The silver market has run persistent annual deficits for more than half a decade. In 2024 alone, the deficit exceeded 148 million ounces. In 2025, estimates push that figure even higher. Deficits are not theoretical. They are filled by draining above-ground inventories, vaults, exchanges, strategic stockpiles, and those inventories are now critically depleted. Shanghai shock visible. Silver inventories on the Shanghai Exchange have collapsed 75% since 2021. They now sit around 780 tons. That sounds like a lot, until you realize it represents less than 2 weeks of China's domestic consumption. 2 weeks. That is not a buffer. That is a warning. Part 5. Flat supply, exploding demand. The supply side offers no relief. Silver is primarily a byproduct metal. Most silver is mined alongside copper, lead, zinc. You cannot simply turn on silver production. Even if prices double, new supply takes years to materialize, if it materializes at all. Meanwhile, demand is structurally growing. Solar silver usage in solar panels has more than tripled since 2015. Electric vehicles, EVs, use 2 to 3 times more silver than internal combustion vehicles. AI and data centers, high-performance electronics, thermal management, and power infrastructure all require silver. And here's the key point. This demand is inelastic. If prices rise, factories do not stop. Production lines do not pause. Manufacturers do not wait it out. They pay whatever is required, or they shut down. That is the definition of pricing power. Part 6. JP Morgan's stunning reversal. For decades, JP Morgan was the most aggressive bear in the silver market. They were fined $920 million in 2020 for manipulating precious metals markets. They ran massive short positions. They suppressed rallies. They dominated paper silver. Then something changed. In 2025, JP Morgan did something unthinkable. They closed their entire 200 million ounce short position. And they didn't just step aside. They accumulated an estimated 750 million ounces of physical silver. Let that sink in. The largest silver bear became one of the largest physical holders. Institutions do not reverse like that unless the thesis has collapsed. This was not a trade. It was an admission. Part 7. The fractional reserve problem. The silver futures market operates on a fragile assumption. Only about 5% of contracts ever demand physical delivery. That allows exchanges and banks to sell enormous quantities of paper silver, backed by a fraction of real metal. Today, the ratio of paper claims to deliverable COMEX silver is estimated at 17 to 1. That means for every ounce available. 17 are promised. If delivery demand rises from 5% to just 6%, the system breaks, and delivery demand is rising. Part 8, the January 1st. Kill switch markets survive on delay. Roll contracts forward. Cash, settle quietly, change the rules later. China's export licensing removes delay. When supply is restricted at the source, arbitrage fails. Inventories cannot be replenished. Delivery pressure intensifies immediately. This is not a catalyst, it is a kill switch. Once thrown, the system must reconcile reality in real time. Part 9, price projections. Context, not hype. The question everyone asks at moments like this is simple. What does price do next? But that question often leads people in the wrong direction. Because in structurally broken markets, price is not a forecast. It is an outcome. So let's be clear from the start. These are not predictions. They are conditional scenarios, each dependent on how much stress the system absorbs before it fractures. Silver does not move because of opinions. It moves because of constraints, and those constraints are tightening. Near-term scenario, 73 or 88. The first scenario is the least dramatic and the easiest to justify. A move into the $73 to $88 range does not require panic, default, or systemic failure. It only requires normalization. Specifically, it requires the gold-silver ratio to revert toward historical averages. For most of modern monetary history, silver has traded between 30.1 and 50.1 relative to gold. In recent years, that ratio has often exceeded 80.1, reflecting suppression, disinterest, and paper overhang. If gold remains elevated and silver merely stops being ignored, this range becomes mathematically reasonable. This scenario assumes no widespread delivery panic stress remains contained. Futures markets continue to function. Cash settlement remains the exception, not the rule. In other words, this is the best case outcome for market stability. It represents the system bending, but not breaking. Crisis spike scenario, $200, $300. The second scenario is where the conversation changes. This range does not depend on enthusiasm, speculation, or retail excitement. It depends on industrial behavior. Silver shortages do not resolve themselves through market balance. They resolve through demand destruction. And demand destruction only occurs when price rises to a level that forces users to stop buying. Here is the uncomfortable reality. Solar manufacturers cannot substitute silver. EV producers cannot redesign supply chains overnight. Data centers cannot pause infrastructure buildouts. So if supply tightens enough, price must rise until margins collapse. Projects are delayed, production is canceled, that is rationing. And in commodity markets, rationing is violent. This is not theoretical. Palladium did this in 2022. Natural gas has done it repeatedly. Nickel did it in 2022, briefly breaking the LME itself. Silver is smaller than all of them. If industrial buyers panic bid to secure supply, price discovery does not move in steps. It moves in gaps. This scenario could unfold within 6 months of January 1st, especially if Chinese export licensing collides with rising delivery demands. The timeline: how stress becomes failure. This is not expected to happen all at once. Markets deteriorate in phases. Many analysts anticipate Q1 2026. Physical stress intensifies, premiums widen, delivery times extend, arbitrage begins to fail. Q2 2026. Delivery failures appear, exchanges increase cash settlement, force majeure clauses quietly activate. At that point, something critical happens. The paper price loses authority. When futures cannot guarantee delivery, the quote becomes informational, not binding. The physical market takes control. And physical markets do not care about positioning, sentiment, or narratives. They care about availability. Part 10. Why this time is different. Comparisons to 1980 are common. They are also misleading. In 1980, the silver market was distorted by a single leveraged family, concentrated speculative buying, a narrow ownership structure. Most importantly, regulators could kill it. They changed margin rules. They forced liquidation. They bankrupted the participants. The playbook does not apply today. Today's pressure comes from Chinese state policy, not speculation, industrial users, not traders, sovereign entities, not hedge funds, thousands of delivery demands, not a single corner. You cannot margin call a government. You cannot bankrupt a manufacturing sector. You cannot regulate silver into existence. This is not a financial event. It is a logistical one, and logistics always win. Part 11, what this means for investors. This is where many people misunderstand what matters most. This is not about trading silver. It is about how you're exposed. And structural breaks. Vehicle choice matters more than entry price. When settlement risk rises, the question shifts from, what is the price? To, will this instrument perform as expected? Physical silver removes counterparty risk entirely. Unhedged silver miners offer operational leverage to price. Paper instruments depend on system integrity. In normal markets, that distinction is academic. In fractured markets, it is decisive. This is not upside chasing. It is risk management in a system losing coherence. Part 12. Disclaimer and reality. Check. It must be said plainly. This content is for educational and informational purposes only. It is not financial advice. But it is equally important to understand something else. Markets do not reveal truth through press releases, official statements, regulatory reassurance. They reveal truth through stress, missed deliveries, rising premiums, changing contract terms, quiet rule adjustments, and those signals are already visible. Conclusion: the end of the free trade era for silver. For decades, silver was priced as if supply were infinite, as if mines could ramp endlessly, inventories were abundant, substitutes were available. None of that is true anymore. January 1st, 2026 marks a line in the sand. From that point forward, supply becomes political, access becomes strategic, price must ration scarcity. This is not speculation, it is arithmetic. The deficit is real, the inventories are drained, the demand is locked in, the clock is visible. The only remaining question is not if silver reprices. It is how high the price must go before the market clears. And when physical reality finally asserts itself, paper promises will not stand in the way.